afternoon, everyone. It's my pleasure to welcome you all to the webinar series part 1 by RBS Auditors. I am Catherine. Today we will be discussing about corporate tax, which was first introduced in October 3rd, 2022. In this session, we'll deal with the basic concept of corporate tax. Over the few next weeks, we will be covering topics such as free zone, related party, transfer pricing, etc. We are excited to have you all join us for this session, and we hope that you will find it informative and engaging. To conduct this session smoothly, we have muted the attendees. If you need any clarification, you can drop your doubts in the chat box. We have also devoted 10 minutes of time for a quick Q&A session at the end of the webinar. Now, I invite the speaker, Mr. Sijan Kiravi, Managing Director of RBS Auditors.
Thank you, Catherine.
Thank you.
Thank you. Good afternoon, good evening. So we'll quickly go through some of the corporate tax decision, laws, cabinet decision, ministerial, everything. If you see corporate tax issued in October 2023, it's relating to 60 pages corporate tax, very simple one. But when you look into that, each section wise, there are a lot of amendment. It came like a cabinet decision, it's issued after that one, then ministerial decisions issued. So we'll briefly look into one by one. So I'll share my presentation. So in this seminar, we are mainly looking into the corporate tax, what its applicable rate, tax year, corporate tax registration, who is subject to corporate tax, base of taxation, guiding principle, then taxable income and exempt income, computation of taxable income, deduction and non-deduction, interest expenditure, small business relief. These are the areas we are planning to cover. Because even if this is a corporate tax, it is just for a simple page, 60 pages, but we cannot cover entire corporate tax in a 30 minutes time. So that's why we are just going through part by part by creating different webinar series. So why corporate tax in UAE? So if you see the corporate tax, it is publicly released on October 3rd, 2022. This is the date when the government has been signed the corporate tax laws. To achieve the 50 years supporting the corporate tax has been introduced. So we will go through some of the session why this corporate tax is introduced. And one area UAE has not yet issued, it is relating to global revenue exceeding 750 million euros that will be subject to 15% tax. That ministerial decision has yet to come. So we'll look into what recent corporate tax is coming to the UAE. So if you go through this one, you can see G20, then you can see OECD, then you can see BEPS. So BEPS action plans, base erosion and profit sharing. There are 15 action points. Out of these 15 action points, some of the points, like 4 points, must be a minimum standard you have to follow. So BEPS action point, BEPS 2, there are 2 pillars, pillar 1 and pillar 2. Pillar 1 is relating to revised profit allocation. Pillar 2 is relating to global anti-base erosion, GLOB. We called it as a GLOB. In that one, we are putting a global minimum tax at the rate of 15%. That means the GLOB rules. And the other one, treaty-based subject to tax rule, STTR, that one minimum rate is 9%. So these are the 137 countries, G20 countries have signed the contract relating to OECD regulations. Out of this OECD regulation, these 137 countries, they have agreed that at least they have maintained minimum standards. So 4 minimum standards, like these are the minimum standard for the OECD BEPS action. Total 15 standards are there. One is digital economy, then hybrid, CFC, interest deduction, harmful tax practices, preventing tax treaty, avoidance of PE status, transfer pricing risk capital, transfer pricing high risk transaction, measuring of monitoring BEPS, disclosure rules, transfer pricing documentation, dispute resolution, and multilateral instrument. Out of these 4 must be all countries. Out of 137 countries, at least 4 minimum standard they have to maintain. So one is relating to, if you see the dispute resolution, whatever the star mark I have mentioned, then transfer pricing documentation, then preventing tax treaty abuse and harmful tax practices. So these 4 standards they have to implement in each country by 137 countries, including the G20. So out of this, UAE has adopted 1st April 2019 for country by country reporting. So this already adopted. After that one, ESR it is adopted, and June 2023, UAE has adopted the corporate tax. If you see the previous slide, it is relating to STTR. STTR, it is means subject to treaty based. So that one is a minimum rate prescribed, it is a 9%. So minimum rate prescribed for 9%, it is relating to connected person transaction. So what UAE has taken, it is like the STTR rate, that's a minimum rate has been adopted into the picture. So straight away, our corporate tax is a 9%. So it's all entire transaction, entire tax rate, then the laws and regulations, everything it is based on OECD principles, OECD principle, BEPS action points, and G20. So out of these standards, they have taken into account. So now let us look at next part, what exactly the corporate tax, what exactly the direct tax, what exactly the indirect tax. If you see indirect tax, it is already adopted in UAE, it is relating to VAT, and relating to direct tax means whatever your total sales, then your expenses, then whatever you are getting for the net income, in that one direct tax will be applicable. So some certain incomes are exempt that we will discuss in other slides. So look at the tax rates. Corporate tax, this for a corporate entity, there is a 2 rates. One is relating to 0% net taxable profit up to 375,000. And if net taxable profit above 375, then it will be taxable at 9%. For other qualifying free zone person, it's a clause number 2. It's like a 0% for qualifying income and 9% on other than qualifying income under Article 18. This pattern will be planning to take webinar in another session, because qualifying free zone, it's a lengthy one. So we will be taking webinar relating to qualifying free zone. So this is the total taxability in UAE. So if you look at the country wise, so you can see the other country, KSA, it is a 20% tax rate. Qatar, it is a 10% tax rate. Oman, it is a 15%, Kuwait, it is a 15%, and UAE, it is 9%. So UAE has adopted STTR rate as it is the corporate tax. The only one thing is a pending one is it relating to globe tax. Globe tax at the rate of 15% is prescribed by OECD as of now. Till UAE has not implemented, not released exactly what's the tax rate for that one. But minimum rate must be 15%. So now look at the taxable year. So taxable year, if you talk about this one, the corporate tax is effective from 1st of June 2023. So taxable year, it is prescribed in this act is a Gregorian year. That means whenever your financial year is starting from Jan to December, that will be treated as a tax financial year. If your tax year is June 1st, 2023 to 31st May, then that will be the financial year. It's not based on the calendar year. Calendar year, it is like Jan to December, but this is based on the Gregorian years. And one more condition, it is specifically mentioned about the taxable year, the transitional rules. Transitional rules means once you are from a low, you are tax-free environment to moving to the tax environment, what will be the transitional rule applicable? So Article 61, it clearly says that opening balance should be prepared in accordance with the arm's length principle. Arm's length principle means all accounting standard you have to follow, and opening balance should be arm's length principle. And they have clearly mentioned about the GAR provision, Article 50, it's relating to general anti-avoidance regulation. I have initially mentioned about the BEPS action point. BEPS action point, one of the point is relating to point number 5, harmful tax practices and treaty abuse. So for relating to that one, action point 5 and 6, relating to that one, the UAE has adopted a general anti-avoidance rules, GAR 50. That means whenever after the law come into force, that is on 3rd October 2022, effective days, after that one, any date you have changed the legal structure or anything relating to avoiding the tax matters, that means to avoiding the tax income, then it will applicable for the GAR provision, even if it is not applicable before June 1st, 2023. That's why the GAR portion is come into the picture. So now let us look at when do we need to register. So we will see that it's an article, it's clearly mentioned that corporate tax, if your financial year is May 31st, that means June 1st, 2023 to May 31st, 2024, then automatically it will be an effective date. And last date of return filing is February 28, 2025, and date of complete the tax registration before 28th of 2025. I have mentioned date of complete the tax registration. That means you can register at any time after June 1st, 2023, but before 28, 2025, you have to register it. If you are taking your financial year is June 1st, 2024, then it's in June to 31st December 2024, then the return filing is within 9 months of the end of the financial year, that is September 30th, 2025, and the date of completion of the registration before September 30th, 2025. And if it is a March 31st, 1st of April 2024 to March 31st, 2025, and last date of return filing 31st December 2020, it's a 31st March 2025, and before 31st December 2025. Now we'll look into the exception. These are the people not need to register for corporate tax. One is relating to government entity. Second one is relating to government controlled entity. Government controlled entity means sovereign fund or other controlled entity type. Then person engaged in extractive businesses as defined in Article 7. And other category, person engaged in non-extractive natural resources. And fifth one, it is relating to non-resident person that derives only state-sourced income, under which they don't have any PE, permanent establishment in this state. Wherever we have mentioned state means United Arab Emirates. So we have seen the registration. So registration deadline for exempt person. So we have just now seen some of the exempt person no need to register, but there are other exempt person. Those people, what will be the registration date? Qualifying public benefits entity, they have to register on or before 1st of October 2023. Then other category, investment funds, public pension fund, judicial person, it's incorporated in the state which is wholly owned and controlled by an exempt person. Then any other person, those people has to register 1st of June 2024. Then within 60 business days from the end of the tax period in which the person met the condition for the exemption. The exemption shall be effective from the start of the tax period. So if once you submit the exemption to the Federal Tax Authority, then they will approve that application. Then every year annual declaration they have to give and saying that they have followed the exemption. In case of a liquidation, if the company is going to liquidate that company, in that case also the exempt person will be treated as a deemed exempt person, but they have to file application to the Federal Tax Authority saying that they are going to liquidate the company. Now we have already discussed about the exception category. Now who will be subject to corporate tax? So first category, all UA companies and other judicial persons, natural person who conducts business or business activity. That means the individual who conducts purely on business activity, then they have to register. Then non-resident judicial persons, foreign legal entities having a permanent establishment in UAE, then judicial person established in a UAE free zone will be treated as a taxable person. So Basically, if you're talking all companies, they have to register, plus natural person who are maybe conducting business or business activity. Then the foreign entities, for example, they have a branch here in UAE, they have to register for corporate tax. So UAE companies, foreign entities, other legal person incorporated in UAE, then any person, individual that earns source of income, that means who conduct business or business activity, they have to register. Now let us look at the basis of taxation, source and residence rule. The source and residence rule, it is taken from the OECD guidelines. So what exactly the source and residence rule? For example, residence rule. It's a residence rule. It is based on the country where the person resides. For example, in case of a company, if the company is registered in UAE, then it is automatically treated as a resident company. So it is like a resident or domicile in that company. Then place of registration, place of incorporation or registration of the company. And another category, they come into the residence guidance. It is like a place of effective management. That means, for example, you have a company set up in British Virgin Islands and you have the entire management person, a place of effective management in UAE, then those person also come into the picture as a legal person under the category of UAE tax law. And in that case, total global income will be taxed based on the resident-based taxation. Now look at the source-based taxation. Source-based taxation means it's wherever the source or income arises. That means the company is registered in some other country, but the income is arising from UAE. Then under source-based, UAE will be taxable. So the principle, it is based on the country which provide opportunity and facility to generate income or profit should also have a tax on that one. So usually this will be applicable in case of a non-resident entities, foreign companies, then all other companies will be applicable. So simultaneously DTA will be signed between different countries. So what exactly we have mentioned about the previous slide relating to residence-based taxation in that one poem. That means a place of effective management. So what exactly the place of effective management, what will be the guiding principle relating to place of effective management? That means, for example, board of directors are regularly meets and makes a strategic decision in UAE, then place of effective management will be UAE. If it is in other country, for example, you are putting in a British Virgin Island, then that will be the place of establishment, like that way. So the second category, it's a board of directors, a de facto means delegate the authority to key management personnel like a senior management or other person or directors, promoters or strategic financial advisors. Those cases, in that case, that place will be, whoever may be staying in that place will be the place of effective management. The other category, it is relating to substantial activity of the company where it is carried out. And the other category, accounting records of the company are kept, then location of the company's head office, registered office. In case of modern technology, because nowadays it's a lot of people are just doing all meetings and arrangements in the modern technology like a Zoom or Teams or webinar and everything. In that case, the majority of them who are maybe staying residently resides, or that will be the resident factor, relevant factor. So now let us look at the taxable person, legal person. So till now I have just discussed about OECD guidelines relating to what basis you will be taxable, either on a resident based or source based. UAE has adopted both resident and source based taxation for this one. For example, a legal person, taxable in case of a legal person. So legal person will be what stage treated as a resident. So legal person, a resident treated as a resident in case of a legal person incorporated in UAE. That means in a mainland or free zone. The second category, legal person incorporated outside UAE but effectively managed and controlled UAE. That means a POEM. If POEM is it in UAE, then automatically it will be treated as a resident of legal person. That means you need not to have a company here in UAE, but you are getting source of funds, source of income from UAE. Then in that case also you have to register. So what are the incomes will be applicable? Taxable income derived from or outside UAE. And what are the incomes exempt cases? dividend from resident judicial person, a dividend from foreign judicial person subject to participating exemption, then capital gain subject to participating exemption, then income of foreign PA subject to foreign tax jurisdiction. Now let us look at a non-resident. Non-resident means foreign legal entities with P. P means permanent establishment in UAE. Those people will be treated as non-resident. That means it's automatically the branch company will be treated as a non-resident, or a representative company will be treated as a non-resident, this category. Then income attributable, what will be the taxable income? Income attributable to P in UAE, that will be treated as a attributable income. Then recently there is an amendment, it's relating to immovable property. Any foreign companies or non-resident judicial person, it clearly says that a judicial person, not for the natural person. Judicial person will subject to corporate tax on income derived from real estate business. So whatever the income derived from real estate business, it will be treated as a non-resident, then automatically tax will be applicable at a 9%. So this is based on the OECD Model Convention, Article 6. So OECD Model Convention, Article 6, it says about immovable property. So under this article, immovable property means immovable property including agriculture and forestry, livestock. But UAE has adopted only immovable property relating to that one. So if you see the other countries, like for example, Armenia, Austria, France, Indonesia, these countries, they have adopted immovable property means including livestock and forestries. And the other countries are excluded, like Australia, UK, Brazil, Belgium, China, Denmark. These people, they have immovable properties excluding livestock and agriculture products, agriculture equipment. So these things are, as per OECD, has clearly mentioned about that one, but even UAE has not included these items. And exempt category, income derived from a non-resident person from operating aircraft or ships in an international transportation. Now, legal person. So legal person will be wherever POEM is there. POEM means a place of effective management in UAE. Automatically, in legal person status, he will be involved. That company will be treated as a legal person. Now we'll look into the natural person. Natural person means individual. So there is a two category. One is relating to expat, then second one is relating to either UAE national or GCC national. In case of individual present in a UAE for 183 days in the last 12 months, then they will be treated as a resident. So in case of UAE national, then the same category, it's within 90 days in the last 12 months. If he is a resident in the country, then UAE national will be treated as a resident, and similarly GCC national will be treated as a resident. So in these cases, they have to show a nexus, like that they are doing a business or business activity, or he is having a residence here, or he is staying here. All these things will be considered as a residential status. What are the income exempt in the hands of natural person? One is relating to interest income. Second one is a dividend income, capital income, earned in a personal capacity rental income. All these things are in the personal capacity. That means you are in a year, you are getting a 2 or 3 income, that is fine. But if you are doing in a continuous way, it's not in a personal capacity, then it will be treated as a business or business activity. And what are the income taxable? It is like income from business or business activity regularly conducted. It's not a one-time transaction, regularly conducted by the natural person, then it will be treated as a business activity. So there is a safe harbor rule. That safe harbor rule means the resident or natural resident or non-resident business activity does not exceed 1 million, then you need not to pay any corporate tax. In case of a non-resident person not considered as a resident, so the definition is a non-considered as a resident, and exempt income not applicable. Taxable income, UAE source income, non-resident individual as a nexus in the connection in UAE, then it will be treated as a non-resident category. So this is just like for an individual expat within 183 days in 12 months period. In case of UAE national or GCC national, then 90 days during the 12 months period, he must have a nexus in the state, or he must conduct a business or business activity. So central vital information, it is relating to he must be staying here in UAE. For example, base of taxation, one example for the resident-based or source-based calculation. A company situated in China, they have invested, ABC LLC, resident UAE, invested in a company situated in China, and they got a dividend income of 100,000, and withhold the tax is a 15%. So after withhold the tax, they have received a dividend income. And another branch, ABC LLC in UK, the branch profit is 1 million, and corporate tax paid in their respective country, it is a 200,000, 20%. Then if you consider this as a total income, so global income will be the total profit from UAE, it is a 5 million, and corporate tax will be 416 to 50. So we look at tax paid in China, it's a 15,000, tax paid in UK, 200,000. As per residency rule, I have explained about the initial residency rule. As per residency rule, there is a global income. So global income means a 5 million plus 100,000 plus 1 million. So total 6.1 million, taxed at a 9%. Tax after threshold. Threshold means a 6.1 million minus 375,000. Then that amount will be taxed at a 9%. Total it will be 515,250. So total tax paid outside UAE, it is like a 215,000. Then total tax paid 730,250. So global tax income total, they have to pay 730,250. But this is without DTA. So if DTA is there, automatically this deduction you will get a 215 deduction you will get, subject to some of the condition. DTA, there is a partial exemption, then full exemption that we will take later stage. So taxable source income, what are these source income? One is derived from income derived from a resident person, income derived from non-resident person having a PE in a UAE, then accrued income derived from activities or assets or capital invested or performed or located in UAE, or any other services conducted in UAE. Then in that case, then this income, whatever the income received, then that will be the source income, like a sale of goods, professional services, contract and so forth. Then movable income from movable or immovable property, income from disposal of shares or capital, income from use or right to use in the states. Then what are the exempt person? Who will be exempted? Like one is relating to government entity and government control entity, person engaged in extractive business, a person engaged in non-extractive natural business, then qualifying public benefit fund, qualifying investment fund, public pension or social security fund, or private pension or social security fund. Then judicial person incorporated for the above purpose. Then whatever the activity they have conducted for investing or holding asset, then those category will be exempt person. In this category, some of the category person no need to register, some category they have to register. That I have already explained in the previous slide. So in this exemption, some of the exemption they will not consider as exempt person. For example, the government company itself, they have a trade license, and then in that case, UACT will be applicable. Then if extraction or exploitation of natural resources, in that one, any support services like suppliers, contractors or subcontractors, in that case, those companies will not be exempt from corporate tax. Then charitable institution carrying out social cultural activities, and make an application to the ministry, and if they are not approved, in that case, then they will not treated as an exempt person. Then charitable institution who undertake commercial activities that are not directly related to their stated purpose, then that means a personal gain or other category, then they will not be treated as an exempt person. Now, Article 22, exempt income. So what are the income and expenditure will not treated as an exempt income, sorry. The following income and expenditure will not be considered determined taxable income. One is relating to dividends and other profit distribution received from judicial or resident person. That means whatever the dividend you have received, then that will not be taxable. And a dividend and other profit distribution in the participating interest. Participating interest means the person who invested at least a minimum of 5% shares in the other entity, then that is treated as a participating interest. In that case, whatever the dividends or interest income, whatever it is received, then it will not be treated as a exempt income. Then any other income from participating interest, that means the same thing. Foreign permanent establishment that meets the condition of Article 24 of the decree law. That means it is relating to a foreign establishment is clearly submit an application to the Federal Tax Authority and saying that other country will be taxable, not at here. In that case, then that income will be exempt. That means the one condition it is that the other country must be tax rate is more than 9%. Then only it will be, you will get an approval. And the final category, it is relating non-resident person carrying out the operating aircraft, ships, or international transportation. In that case, then Article 25, these are the exempt category. So now look at the taxable income. What are the income will be taxable? So taxable income of each taxable person shall be determined separately on the basis of adequate standalone financial statement. So if you are preparing a consolidated financial statement, it must be standalone financial statement. You have to bifurcate separately. So what are the, one is relating to accounting net profit as per financial statements, then non-deductible expenditure, unrealized gain or loss, then net interest. These will explain in detail. Then donation, bribes, dividend and profit distribution, then less exempt income and relief, then that net will be the taxable income. That means whatever the accounting net profit as per IFRS. That means it must be maintained on an accrual basis. You cannot maintain on a cash basis. You can maintain on a cash basis only in case of your revenue is up to 3 million. But what you have to do, you have to give an application to the ministry, application to the Federal Tax Authority, saying that you are following on a cash basis. Then you have to get a permission. Then only it is possible for a cash basis of accounting. And now the accounting income that will be adjusted with the following. One is relating to unrealized gain. That means the fair value of the accounting of capital asset. That means, for example, your capital asset has been fair valued, investment in associate or investment in equity or investment in shares or anything, that one fair valued. In that case, unrealized gain, that will be, you have to add it back. Exempt income, I have explained previously that a dividend or participation interest or income from the operating of ships or aircraft, that area you have to add it back. Relief for qualified group and restructuring relief, deduction and deductible expenses, then transaction with the related parties and connected person. This is another critical area that we will discuss in later stage. Then tax laws, then incentives and special relief for qualifying business activity, then any other income, whatever prescribed by the minister. So if you look at that one, deduction and non-deduction, deduction, you will get whatever the business expenses other than capital expenditure, then payment to connected person subject to align with the transfer pricing documented TP, transfer pricing, then whatever the VAT related irrecoverable VAT, then entertainment expenditure relating to 50%, you will get a claim, then interest expenditure relating to 30% of EBITDA, you will get a claim. Whatever the non-deductible expenditure, it is relating to non-business expenses, you will not get any deduction. Income tax imposed outside the state, you will not get any deduction. Fines, penalty, bribes or similar payments, you will not get. Then donation, grants, gift, qualifying public benefit, exempt income expenses. So deductible expenditure, deduction will not be allowed for expenditure not incurred for the purpose of a taxable business. Expenditure incurred in deriving exempt income, then loss not connected with or arising out of taxable business, then dividend paid by UAE companies, such other expenditure as may be specified by the minister, these expenses. So basically it's talk about whatever the business related expenditure, you will get a deduction. Non-deduction, it's a donation, grants or gift or entity that is not a qualifying public benefit. If it is a qualifying public benefit, that is exempt category of person. So if you are giving any donation to those people, then you will get a donation deduction, otherwise no. Fines and penalties other than amount awarded as a compensation or damage or breach of contract, bribes, then dividend, then amount withdrawn from the business by a natural person, either as a partner in an unincorporated partnership, then corporate tax imposed on taxable person in UAE or outside UAE, then recoverable input value added tax, interest expenditure subject to certain rules. So that means that we'll explain in detail. So unincorporated partnership means you have both the partners are doing the business, but you are not incorporated the company, but with court agreement or something like that. That means a company A and company B is set up an unincorporated partnership without having a trade license. That category of business is treated as an unincorporated partnership. Now let us look at Article 32 relating to entertainment expenditure. These are the expenditure we have already mentioned about. So entertainment expenditure relating to customers, shareholders, suppliers, or other business partners, strategic business partners, relating to meals, accommodation, transportation, admission fee, facility, or equipment used in connection. That means a total overall expenditure, you will get a deduction up to 50% of entertainment expenditure. For example, one company, mainland company, XYZ LLC, having a profit of EBITDA, having a profit of 1 million, consisting of entertainment expenditure of 200,000, donation 50,000, traffic fines 1,000. How much will be the UAE corporate tax amount payable? So first net profit for the year, 1 million. Out of this non-deductible expenditure, entertainment expenditure, it is a not deductible 200,000, donation 50,000, traffic fine 1,000, total 251,000. Out of this entertainment expenditure, you will get a 50% deduction, so 100,000. Then adjusted net profit equal to 1.1 million. In that adjusted net profit, you will get a deduction up to 375,000, 0%, balance 776,000. You have to pay tax at the rate of 9%, 69,840. So total tax liability 69,840. So even if your profit is 1 million, you have to arrive at adjusted net profit. Then adjusted net profit is 1.1 million. In that, one tax will be calculated. It is not based on straight away, not based on net profit. It will be based on adjusted net profit. Now we will look at interest expenditure. So interest expenditure, subject to the provision of Article 28. Article 28 is relating to deduction, and subject to the provision of Article 30 and 31, you can carry forward up to a maximum period of 10 years. So what is the Article 30 talk about? Article 30 is to talk about the interest expenditure. You will get an allowed interest expenditure up to 30% on EBITDA. EBITDA means earnings before interest, tax, depreciation, and amortization, excluding any exempt income. Up to 30% you will get a deduction. So this 30%, if it is whatever the disallowed 30%, that will be carried forward to next 10 tax periods. And recently they have issued one ministerial decision relating to this one, safe harbor rule. The threshold fixed for this one is AED 12 million, and this AED 12 million will not subject to general interest deduction under Article 30. So if your interest expenditure is above 12 million, then the interest deduction limitation rule will be applicable. Now we look at the article. So this interest rate general deduction will not be applicable in case of a banking business, insurance provider, natural person undertaking business or business activity in the states, and any other person as may be determined by the minister. Now we look at the specific interest deduction limitation rule, Article 31. This is basically relating to deduction not allowed for interest expenditure incurred on loan obtained directly by a related party. So one is relating to dividend or profit distribution, redemption or purchase or reduction of return of share capital, capital contribution, acquisition of ownership interest. So if there is a related party loan, in that related party loan, you have fixed interest on that one, you will not get any deduction on related party interest if it is relating to for profit distribution you are taken a loan, for redemption or repurchase or return of share capital for the purpose you are taken a loan, or capital contribution or acquisition of another company you are taken a loan from another related party and you are fixing an interest on that one, then you will not get any deduction. If you want to claim such type of a deduction, any other than this one, you want to claim this one related party loan deduction, you have to demonstrate that the main purpose of obtaining loan is not relating to avoiding the corporate tax. So another condition it is relating, for example, a company is situated in a holding company in UAE, and they have taken a loan from the external bank, portion of a loan, and with that loan they have invested in another company in B, in another UAE company. Then whatever the capital investment at the year end, they will get A and Z dividend. In that case, whether that interest expenditure debited by the holding company, whether you will get a deduction or not. So there is a specific clause, say that clause 2 of Article 28, that clearly mentioned that notwithstanding to this clause, Article 28 is clearly mentioned about the deductible expenditure. In that deductible expenditure, they are clearly mentioned that they will not get any expenditure related to exempt income, but subject to one condition, it is relating to if it is the above type of arrangement, then that interest income you will get deduction. For example, we will check another category, interest expenditure, how it should be treated. For example, ABC LLC, they have EBITDA, earnings before interest, tax, depreciation and everything. It's 100 million, including exempt income. Exempt income is 20 million, interest income is 30 million, general interest expenditure is 70 million, specific interest expenditure, that means a related party expenditure, it's 10 million. So how much you will get a deduction? EBITDA, it is 100 million. Out of this, I have clearly mentioned that 20 million is included in the EBITDA. So exempt income I have already reduced. Then EBITDA excluding interest income is 80. 80 into 30%. So 24 will be eligible for interest deduction for the first year. Now look at the general interest expenditure. Total general interest expenditure is 70 million. Out of this, interest income is 30. Net interest expenditure 40. So total net interest expenditure is 40. Then the previous calculated one, this 30% of EBITDA as per Article 30, it's 24. You are reduced to 24, 40 minus 24, then 16 will be disallowed for this year, but carry forward to next 10 years as per Article 30, subsection 4. But the general specific interest expenditure of 10 million, you will not get any deduction. That means you have to add back this expenditure. Now we look at small business relief. What exactly is small business relief? So if your revenue is below 3 million, in that case, in the relevant tax period and previous tax period, if both the conditions must be satisfied, then you will get, if the condition is must satisfied, then you will get small business relief. If no, then you will not get a small business relief. So small business relief, the condition it is mentioned about the small companies whose turnover it is below 3 million. If it is above 3 million, it is not applicable. Then the condition it is that SBR will not be available for a qualifying free zone person and M&E group. That means exempt person, qualifying free zone person, then M&E group will not get any small business relief. Other condition, if you are claiming the small business relief, then you will not get any interest expenditure deduction for that one or any other category. But if you do not elect for a small business relief, then you can do a carry forward of a loss or anything. And one provision it is says that Article 50 initial stage I have mentioned about the GAR provision. In that GAR provision, it's clearly mentioned that if the entity has been doing for a artificial separation of business. So you want to make it like a 3 million turnover for each company, then you are artificially separating the business. In that case, the GAR portion will be applicable, general anti-avoidance rule, then automatically FTA will be imposed a tax on that one. So this article, it clearly says that after October 3rd, 2022, whatever the artificial separation of business, then automatically Article 50 will be come into the picture. So this is basically the brief introduction relating to major corporate tax areas. Then we will be conducting some other webinar relating to various sections like a free zone, related party, and connected person, tax group, transfer pricing, and other related topics. This will be informed in later days. So you can also visit our YouTube channel. We have brief videos we have given, like for example, who is a non-resident person. It is just for a 4 minutes video, 4 or 5 minutes video. Then what income of a corporation or business are subject to corporate tax, then 0% or 9% tax, then the brief idea about what is a corporate tax. All these things you can just look into our YouTube channel. We have clearly give a simple way how the corporate tax will be applicable. So this is all about our presentation. Then we will look into some of the questions raised by any of the attendees. Somebody asked, Anas Saraj, free zone companies are also have to register with the corporate tax. I have clearly mentioned in the previous section, only exempt category. Exempt category, it is only for 5 category only it will be applicable. All other entity, including free zone or mainland companies, they have to register for corporate tax. If even if the individual is this is the exception for registration. So if it is a government entity, controlled entity, person engaged in extractive business, person engaged in non-extractive natural business, non-resident person that derives only state-sourced income, in that category, do not have a permanent establishment. In that case, only no need to register. That means all entities must register for corporate tax. So whatever the 0% tax and everything, after registering, then you have to put the total taxable income, then you have to get a relief for that one. That basis, we will be conducting this free zone in detail for the next webinar. So you can look into that one. Then we'll give full details about the free zone, how the entities will be working. Free zone, some of the clauses are still they have to issue. So we are just waiting for those things. Then we'll give a full update relating to free zone. Thank you for joining this webinar. I think that it's very useful for useful information. So if any comments or anything, you can comment on your chat box relating to a webinar, and any other section if you want to take, you can just inform to us. Thank you for joining. Thank you very much.